Introducing a beginner's manual on technical analysis, a comprehensive video series tailored specifically for those who are new to the world of trading. Whether you're just starting out or looking to deepen your understanding, this series is your roadmap to success. Throughout the series, we'll cover everything you need to know to get started with technical analysis. From understanding chart patterns to deciphering key indicators, each episode will equip you with the knowledge and skills necessary to make informed trading decisions. So, if you're ready to take the first step towards becoming a confident and successful trader, be sure to subscribe to our channel and hit that notification bell so you never miss an episode. Together, let's unlock the secrets of technical analysis and pave the way for your trading journey. Let's dive in. Hey there, fellow traders, and welcome back to Risk with Purpose, your ultimate destination for learning to trade with confidence and precision. I'm Technical Tiffany, and in this video, we will be learning about Fibonacci retracements and extensions. Fibonacci retracements and extensions are powerful tools used to identify potential levels of support and resistance, as well as to forecast future price targets. Let's dive in. Fibonacci retracements. Fibonacci retracements are used by traders to identify potential levels of support or resistance. It's based on the Fibonacci sequence of numbers, a mathematical sequence in which each number is the sum of the two preceding ones, 0, 1, 1, 2, 3, 5, 8, 13, 21, etc. The sequence is named after Leonardo of Pisa, who is known as Fibonacci. He introduced the sequence to the Western world in his book, Liber Abaci, the Book of Calculation, in 1202. However, the sequence had been described earlier in Indian mathematics. The Fibonacci sequence appears in various aspects of nature, such as the arrangement of leaves on a stem, the branching of trees, the spiral pattern of shells, the arrangement of seeds in a sunflower, and the growth patterns of certain plants. From this Fibonacci sequence of numbers is derived what is known as the golden ratio. The golden ratio is often associated with aesthetic beauty and harmony. It has been used by artists, architects, and designers throughout history to create visually pleasing compositions and structures. It is believed that organisms may exhibit growth patterns that optimize space utilization and resource distribution, leading to the emergence of the golden ratio in biological systems. In financial markets, the golden ratio is used in technical analysis to identify potential support and resistance levels. Fibonacci retracement levels, which are derived from the golden ratio, are believed to represent key areas where price may reverse or continue its trend. Fibonacci retracement levels are calculated using these numbers and are applied to price charts to identify key areas where price may reverse or consolidate. Fibonacci retracements can identify potential levels of support or resistance based on ratios derived from the Fibonacci sequence. These ratios are applied to significant price moves in financial markets to identify key levels where price may find support during pullbacks in uptrends or resistance during bounces and downtrends. Traders begin by identifying a significant price move on the chart. For uptrends, this involves selecting a swing low, lowest point, to a swing high, highest point, while for downtrends, it involves selecting a swing high to a swing low. Once the significant price move is identified, traders plot Fibonacci retracement levels on the chart. These levels are typically represented by horizontal lines at key Fibonacci ratios, including 23.6%, 38.2%, 50%, 61.8%, and 78.6%. How to interpret Fibonacci retracements. Fibonacci retracement levels act as potential areas where price may encounter support or resistance during pullbacks or bounces. These levels are based on ratios derived from the Fibonacci sequence and are believed to reflect natural levels of buying or selling interest in the market. Traders often look for confluence between Fibonacci retracement levels and other technical indicators or chart patterns to validate potential reversal zones. Common indicators used in conjunction with Fibonacci retracement include moving averages, trend lines, oscillators, and candlestick patterns. When price approaches a Fibonacci retracement level, traders observe price action and volume to determine whether the level is acting as support or resistance. A bounce off a Fibonacci retracement level may indicate a continuation of the trend, while a breakthrough and subsequent retest may signal a reversal or consolidation. Fibonacci retracement levels provide objective reference points for traders to identify potential areas of interest in the market, enhancing the precision of their trading decisions. Fibonacci retracements are widely used by traders across different financial markets due to their simplicity and effectiveness in identifying support and resistance levels. Fibonacci retracement levels are dynamic and adjust to changes in price, allowing traders to adapt their analysis to evolving market conditions. Fibonacci extensions. While Fibonacci retracements forecast where potential support and resistance may be, Fibonacci extensions are used to forecast potential future price targets beyond the current price action. To apply Fibonacci extensions, traders identify significant price moves and plot Fibonacci extension levels, typically 127.2%, 161.8%, 200%. 261.8%, and 423.6% on the chart. Fibonacci extension levels act as potential areas where the price may reach after a significant price move. Traders use Fibonacci extensions to set profit targets or anticipate where price may stall or reverse. Fibonacci retracements and extensions are commonly used in trend analysis to identify potential levels of support and resistance within a trend and to forecast future price targets. But smart traders never use these as a standalone tool. They often use Fibonacci retracement and extensions in conjunction with other technical indicators or chart patterns to confirm potential reversal zones or price targets. Fibonacci levels can also be used to set stop-loss orders or determine risk-reward ratios by identifying potential invalidation points or profit targets. And that's it. Thank you for joining us on this journey into the fascinating world of Fibonacci retracements and extensions. We hope you found this video informative and useful to you in your trading journey. If you found this video helpful, be sure to give it a thumbs up and hit the subscribe button below for more insightful content on trading and investing. Also, don't forget to leave a comment sharing your thoughts or any questions you might have. We love hearing from you all. And for those eager to dive even deeper into the world of trading, check out the links in the description for recommended resources and further learning opportunities. Thanks again for watching. And until next time, may your charts be clear and your trades be profitable. Happy trading!